Welcome to the first session of day 2 of the 19th Annual Milken Institute Global Conference. It's a bit early for a meaty subject such as we're going to cover today, but I think we have the panelists that'll be able to tackle it for us. So people will be coming in as we start the session. I'm Ross Duvall. I'm the Chief Research Officer here at the Milken Institute and will serve as moderator of the U.S. overview, Will Recovery Prevail? Question mark. It's a question mark because we hope to answer that question. We have a panel with a great deal of breadth and depth of knowledge, and I'm looking forward to hearing their insights. So we're going to explore whether the U.S. economy will overcome foreign headwinds, falling oil and gas exploration here in the United States, and turbulence in financial markets. And unlike previous years, we can't blame the weak economy on a bad winter. We had a very mild winter, and yet the first quarter was very weak, coming in an annual growth rate of only 0.5%. And most readings on the first quarter were fairly weak. A quick rundown first of the things we're going to cover today. If I could have slide 1, please. The average household has saved about $1,500 per year from lower gasoline prices. But is the consumer starting to spend that money? Where's the evidence? Slide 2. The housing market has begun to recover and prices are also rising again. But how much growth can housing provide for the U.S. economy? Slide 3. Capital markets. Capital goods orders have been weak over the past few months, and even when you exclude the fall off in energy exploration, core capital goods have been very weak. What's missing from the equation? Why are businesses not confident enough to invest in CapEx? Slide 4. I want to talk a little bit about the Fed and has it lost its firepower. This shows you the balance sheet of the Federal Reserve now hitting $4.4 trillion. Slide 5. Imports have been outpacing export growth for the past year and a half or so. Higher dollar, weaker foreign growth. How much of a drag will foreign trade be on the U.S. economy? And slide 6, we'll even get an opportunity to talk about some of the longer-term issues such as productivity and what's the potential growth of the U.S. economy. Let's go to our panelists. I'm going to introduce them in alphabetical order. First, we have Monty Bennett, to my far right, your left, who is founder and chairman and CEO of the Ashford Group of Companies. Someday I'd love to have all 3 of those titles. Next to me, to my right, is Juan Enriquez. He's the managing director of Excel Venture Management. To my immediate left, Fred Hochberg, chairman and president of the Export-Import Bank of the United States. And next to Fred, we have Judith McKenna, Executive Vice President and Chief Operating Officer of Walmart US. And you'll have to guess where her accent comes from. And last but not least, Blue Putnam, Chief Economist and Managing Director of Strategic Intelligence and Analytics at CME Group. Let's start with the heart of the matter, the American consumer and the job and wage growth that determine their health. Given the weakness in foreign demand that I already talked about, the high value of the dollar, and also the plunge in exploration activity in the U.S., what happens to the American consumer, it seems to me, will be critical in determining the path forward for the U.S. recovery. Judith, what I'd like to do is turn to you first. Many retail analysts were forecasting that there would be additional consumer discretionary income available from the savings on gasoline purchases. They started falling in November of 2014. Economists have estimated as much as $80 billion of purchasing power might be available. Have you seen any signs that consumers are starting to spend this?
Yeah, so good morning. Undoubtedly, it's put additional dollars into consumers' pockets. the statistics on that are really clear. But we've also seen some trends that we saw last year in terms of when people do have additional dollars, they're also using it to pay down debt as well as to start making savings as well. And we saw some external research recently that said actually less than 60% of people thought that it was making a material difference to their budgets. Now, that may or may not be true, because I think that one of the things that's coming into play here is people's perception and confidence. And I think you're both seeing it with the dollars from gas savings as to whether they choose to save it or whether they choose to spend it, but also just in the way they're living their lives at the moment. And we did some focus groups with a panel of mums who, we have 140 million people a week who walk through our doors. And we talked to the mums about how they're feeling at the moment. And what was really interesting is the economy is front and centre for them. You know, some of the political uncertainty is adding to that, their nervousness around it. And I think that might be driving some of the behaviour that whilst we're seeing it translate, we're perhaps not seeing it as translate as much as people would expect. When it does, what I know is value is the number one thing that's on their minds.
Sure. Monty, let me turn to you. Are there any signs that the consumer may be spending those additional discretionary dollars on purchases of services as opposed to goods?
I think I'd agree a lot with what Judith had to say. We own 140 hotels across the country, everything from Hampton Inns to the Bardessono Hotel up in Napa Valley. And we're able to see the behavior of consumers, whether it be leisure travelers or corporate travelers, corporate and group travelers, both at the mid-scale, low scale, up to the very high end. And ever since the Great Recession, we've seen strong growth in demand in those sectors, one more than others at different times. But right now, what we're seeing is the leisure travelers continuing to hang in there, and we're seeing growth. Not as strong as we would have hoped. We don't see them spending all of those $1,500 or so of savings that they're experiencing in the reduced gas prices. But over on the corporate side, on the group side, we're seeing the environment a little choppy. We're seeing a little more reluctance to book short-term groups on the smaller side. And the individual business traveler, we're seeing a little less growth than we normally would see in the past number of months. Now, in the past, we've seen slowdowns like this, and it would turn around and pick right back up. So it's really hard to say whether it is an indicator of the future. But you don't have a recession, at least until this starts. Our business is one that's ebbs and flows simultaneously with the economy. So as GDP drops, so does demand for hotel rooms. Hotel and travel is one of the first items that gets cut in a recession, both by leisure travelers and by corporations. They'd rather cut travel than start laying people off, and so that's what gets cut first. And so I'm a little concerned that this cutback in travel, or I should say slowdown in the growth of travel on the corporate side, is a prelude to layoffs, which we haven't seen yet in the economy. So we'll just have to wait and see whether this is a blip or whether it'll pick up and gather steam as a recession. We're also seeing some credit tightening, both in commercial real estate and in other sectors, and this is a concern as well. So we'll continue to watch all the indicators, and if this credit tightening continues to pick up, that could spell real trouble for us.
Thank you, Monty. Blue, as a fellow economist, you follow the debate on the sometimes technical discussion on the potential growth rate of GDP. So in other words, what's your production function? What do you see as the underlying potential growth of the U.S. economy today?
It's not as much as the policymakers would hope. If you're looking at this slide here on labor productivity, you can see it's all over the map, which tells you, by the way, that we have no idea how to measure it. So I really wouldn't look at labor productivity. No, you can see it goes down during recessions. It goes up other times. It's not measuring productivity. So let's try slide 58. We are slowing down as a country because we don't have labor force growth anymore. It's maybe 0.5% on some trend basis. And on average, over time, you're only going to get 1.5% out of labor productivity over, like, say, a decade. You know, it'll go up, it'll go down. So that means we're a 1.5% or 2% potential growth economy. And so you have the presidential candidates, the Federal Reserve, all these people trying to make it grow faster than it really is. But that's just because we don't have much population growth and much labor force growth, and we're aging. My tennis game isn't as good as it used to be, okay? But it's still pretty good. And I think we have to look at the U.S. economy that way, is that as our retired population is a higher percentage, they're not going to spend as much per capita. Well, maybe on healthcare, but nothing else. Because you don't need that new pair of shoes, you don't need that new car necessarily as the economy ages. So that's part of what's going on here. But I would like to say, we have an exceedingly healthy, robust economy. Just because we're only a 1.5%, 2% growing economy doesn't mean it's not healthy. We're growing at our potential. We have a very robust economy in the sense that we can sustain shocks. We can come back better than most other economies in the world. So a healthy economy is not measured by its potential GDP growth rate.
Thank you very much, Blue. Juan, let's get into innovation. Can you share with us what you're seeing in the United States and our capacity and ability to innovate? In other words, what's our competitive position?
So let me involve all of you in this. What I'd like you to do is, over the course of 15 seconds, take your neighbor or take two of your neighbors and think with your neighbor of all the large US companies that you can name that didn't exist 2 or 3 decades ago. So you've got 15 seconds. Please turn to your neighbor and just share. All right, your time's up. So please raise your hand if you came up with 3 companies as a group. Oh, it's reasonably easy. How about 5? Raise your hand. How about 8? Raise your hand. How about 10? Couple. Great. Now let's try the same exercise next 15 seconds. Large European companies that did not exist 2 or 3 decades ago. Ready? Go. All right, your time's up. Raise your hand if you have 3. Raise your hand if you have 5. Was that a little bit harder? So here's what's happening. It's not because there aren't great European brands, right? We all love Ferraris and Louis Vuitton and Chanel, and I mean, there's incredible European brands. But if you take the 15 most valuable tech companies in the US in 2000, worked for 13 years, 3 of those companies are more valuable. 12 of them are less valuable, and several of those don't exist anymore. So what's happening is you've got this absolutely incredible wave of technology that while you're watching what your competitor's doing and you're working on the next quarter, these waves of technology come in, they just wipe you out. Whether you call it Uber, which is now at $68 billion, which is 70% more than the S&P 500. And the bottom line is venture capital is funding 0.2% of the US economy. It's 11% of US jobs. It's 21% of US economic output. So it's actually important to have a little periscope into venture. I'll stop there.
I thought I knew where that was headed, and it ended up there. Fred, international trade has been in the crosshairs and the controversy of the past year or so. First, kind of the roadblocks in Congress, and I know those roadblocks haven't been completely removed yet. We're getting closer to removing all of them. But there's been a lot of bashing of trade in the presidential primaries on both sides, no question about that. Everyone seems to disown trade. They never voted for it. They never supported it. But before we get into that, I wanted to get your sense of just how much weaker growth are we seeing abroad and how that's affecting exports in the United States and our ability to compete in the export market.
Sure. Well, exports certainly U.S. exports, particularly manufactured goods, had a decline last year after having about 5 years in a row of continuous growth. President Obama had announced we're going to double exports in 5 years. We got close to 50% increase, but with substantial headwinds. A number of countries, we actually did double our export growth. Particularly with the change in commodity prices and particularly oil prices, there's just a huge shift from producers to consumers, and I mean producing countries to consuming countries. And I actually think it's going to bring forth, in time, it'll take a little time, a lot of economic reforms as these countries are retooling and reforming and finding new ways to run their economies. I've seen that firsthand in Saudi Arabia, in Egypt, in India, in Indonesia, where fuel subsidies are being reduced or eliminated. Bankruptcy laws are changing, attempts to change property transfer rules, formation of small businesses, lending to small businesses, cutting of red tape. Countries are competing, for example, on being the most competitive or good places to start a business. So I think those are some countervailing trends that actually aren't being counted. They're being discounted to zero. I think that's an exaggeration. I think there are a lot of headwinds, but I think as a result, we're seeing a number of things that are going to go in the right direction in terms of those economies building up, and this will also cause a lot of more infrastructure investment, which ultimately make the world more productive as well.
Thank you, Fred. Let's go back and look at the consumer sector and housing just a bit more. I mean, housing grew at an annual rate of over 10% in the first quarter of this year. Judith, are you seeing any signs and strength in housing as it relates to furniture or appliances or other items related? I mean, slide 9, I think, lets you see some of the durable goods growth has been fairly strong over recent quarters, although in the first quarter of 2016, it was a little weak. But are we starting to see consumers put items in their homes?
Yeah, so I think that undoubtedly the housing growth has been a key driver for consumer spending. And it was a trend through last year. In our Q4 results, we talked about furniture and home furnishings doing very well for us. And, you can see that in terms of the spending patterns from people. And there's been a couple of reports that have shown that's been something that's been quite strong over the last couple of years as well. I think what's happening at the moment, and again, from a consumer perspective, which is whilst we've got an aging population, Blue, we've also got 79 million millennials coming into the peak of their spending power. And they're just beginning to get into that period of household formation. And with that comes the housing market, and there is everything that goes into the basket with that as well. So definitely seeing that from a millennial generation coming through and starting to spend. The other one that we're seeing as a trend within this is it depends where you are in the country. So we've touched on oil and some of those things. And again, depending on where you are, the strength of housing we're seeing trends that differ by different parts of the country too.
Sure. If we could look at slide 11, please. It does appear that the consumer is going to deleverage their balance sheet in the aftermath of the financial crisis. Is that over? Have consumers largely deleveraged, and are they back on a sustainable basis now? Are there any concerns about the consumer being overextended? Anyone? Monty?
The consumer's in good shape, by and large. There's almost full employment or close to it, and they've recovered nicely from the recession. The consumer's the bright spot where we are. It's more on the corporate side of the manufacturing side that there's could be trouble. If I could ask to turn to slide 32, the real trouble we have is not just on the consumer side, but just on the total debt side, and this is all debt in the economy. And you can see that it's north of $60 trillion and continues to grow, even as the Fed funds rates there, that orange graph, continues to drop. And the challenge we have is that the stock of debt is so huge that any increase in the average interest rate is a huge amount of money that is pulled from spenders, borrowers, and it goes to savers/lenders. So a 1% increase in the average interest rate in our economy is approximately $620 billion pulling out of the hands of consumers and spenders to savers, banks, pension funds, and the like who save and don't spend. Well, $620 billion over an $18 trillion economy, that's a huge amount of de-stimulus. And that's what we've got to concern ourselves with. And that's why the Fed is right to pause on their interest rate increases. So the consumers particularly are in good shape, but overall, we're not in good shape from a debt standpoint.
If I could, Judith, let me turn to kind of the question of where are consumers spending their income. A lot of people felt that online sales would mean the demise of kind of brick and mortar, but tell us how that consumer behavior pattern is evolving over time.
So undoubtedly, we've talked about innovation, and many of the businesses that are doing well are innovators in how they bring product to consumer. And that's a trend that we're continuing to see. I think the two things that we hear loud and clear from consumers, whether it be for their grocery shopping or for their home furnishings, is that the two things that they're most interested in are value and convenience. And convenience means how can you get something to me in the most effective and the most speedy way. And I think if I look at our business and think about something like online grocery shopping, which had been done in pockets around the US a few years ago, as we're starting to roll that out into new markets, the uptake of that has been very significant. And it plays absolutely into this integration for customers and consumers they don't distinguish anymore between bricks and mortar and online. They actually see this as one seamless experience. And the challenge for retailers like ourselves, which is a traditional bricks and mortar retailer originally, is how do you also become a tech company and actually get in front of some of those trends and transform your business models.
Fred, I know that you used to follow consumer spending pretty closely in one of your previous positions at Lilly and Vernon. My guess is you still pay attention to it every once in a while.
Less.
But
keep going.
Yeah, I can understand. So I wanted to get your sense of what do you see these trends? I mean, you worked in this area for a number of years. How is this evolving?
Well, I probably see it more clearly overseas, which would have an impact on our economy, and that is, I think we discount in the United States. The number of people entering the middle class globally is increasing by staggering amounts. And middle class is frequently defined as people have more money than food and shelter. I was in Bangladesh, one of the poorest countries in the world, and within 5 years, there'll be 33 million people in a country of 160, quote unquote, middle class, which means they have disposable income. Which means they want things like things that we take for granted, electricity 24 hours a day, 7 days a week, better access to a better diet. We have probably too much access to a better diet. Transportation, better schooling and education, a lot of the things that we actually manufacture and sell and export in the United States. So from a consumer point of view, I probably have a little better handle on what I'm seeing abroad. It is growing much more rapidly. India is a very large consuming public, and yet has huge infrastructure deficits. So, as those things come into play, I think there's a lot of demand that will be generated by that feels a little bit masked by the economic data we're looking at now.
Monty, if I could turn to you on this, anybody else can jump in. I want to get a sense of how the reductions in oil and gas exploration activity is affecting regional purchasing patterns. Are you seeing that in your leisure hotels activity?
We definitely see it. And as the fracking boom has taken hold in the United States, a lot of the oil produced and consumed, rather, I should say, is produced here in the United States. And in some markets, particularly Houston, where I grew up and suffered through the oil busts of the 80s, it is going through another tough time. There's definitely material fall off in occupancy in hotels in the Houston area. Meanwhile, though, interestingly, other cities like Dallas and like Denver, which in past periods suffered greatly under oil busts, are still continuing to thrive and do very, very well. The hotels there and overall economic activity. So those cities have successfully diversified. But it is definitely having an impact in some markets, especially some of the other shale markets, Western Pennsylvania, the Dakotas, and the like. It's having an impact, and unfortunately, that's offsetting the benefit that consumers have from this extra disposable income from lower oil prices.
Let's move to wages. I mean, that's one of the questions is when is wage growth going to accelerate? Is it going to take that to propel the consumer forward? Slide 14, please. It'll give us a sense of just how job creation has been running consistently above 200,000 a month. Blue, what do you see? Are we at potentially a tipping point where the labor market is tightening enough to push wages higher?
No. We have a labor market that's creating a lot of jobs, without a doubt. It's healthy in that sense. And the jobs are what supports the retail sales and housing formation and all these good things. So it's all good in that part. But the relationship of the tightness of the labor market to inflation and hourly wages is quite way overstated. Since 1994, we've essentially had core inflation. You don't eat your house or anything, but take out food and energy. We've had core inflation between 1% and 2%. We've had a tech rally and a tech wreck. We've had a housing rally and a spectacular bust. We've had quantitative easing. We've had zero rates. So something else is, and during that whole period, inflation has just been zigzagging around in a very narrow band. And so what this tells us is that something really very different is going on in all markets that influence inflation, like the wage market. And I think this is where you really have to understand the technology side of it and how the economy is changing. If you're a problem solver kind of worker, your wages are going to rise. But if you're doing a task that somebody else could do, and I'm intentionally not using the old words because they're very, very different. I mean, my plumber is a problem solver. He's going to do just fine. But you know, those jobs that the technology has made easier and more reproducible are not necessarily going to see wage growth. And it's an internationally competitive market that also adds another dimension to that. So I don't think we're in a tipping point, and I also don't think any of the research over the last 20 years that fails to understand how the economy changes is worth looking at. Sorry, Janet Yellen, but your dissertation is out of date.
I would agree that it probably needs to be updated.
She wrote on the labor markets in 1980, and actually it's a very, very good research study of why wages weren't cut in the recession of the time. So, but it's not necessarily applicable today.
Right. Let's turn to small businesses. They have not been creating jobs at the rate they normally do in previous recoveries. Why has our business startup rate deteriorated somewhat? And has it really? I mean, Juan, what do you get a sense for is happening in the entrepreneurial world in the United States?
So if we can just put that labor chart up, it kind of reminds you of the person who's standing in the bucket of cold water and the bucket of hot water and says the temperature's fine. Because on average, it looks like that. But what you've really got is you've got this tale of three different logics going on. And I'll tell you a short story about why New Mexico is not the richest state in the union per capita. And that's because this company was growing so fast that it couldn't get a bank to finance its receivables. Tried to get $500,000. And that's about as safe a loan as you can get. But it had no hard assets, so the banker said no. So the kid did what kids normally do, calls dad. Dad, I need a loan. Dad says, I don't have $500,000, but I'm playing golf with a friend of mine. Friend of his is a banker. Says, yeah, I've known this kid for a long time. I'll loan him $500,000. But we only can lend within a 30-mile radius of our bank. So he has to move his company here. And that's the reason why Microsoft moved to Seattle. Because that kid was Bill Gates.
Yeah.
And it was a $500,000 loan that should have made that cluster that's sitting in Seattle with Amazon and Red Hat and all these folks. So one island of this stuff works with individuals. And I want you to understand how powerful individuals are, right? So when Nina Tandun, who's sitting right here, says, look, I'm going to go out and build bones and the next cartilage thing, she's not thinking small business. It's a small business by that graph, but it's a different gig. When Bill Gates starts his business, when Bill Gross, who's sitting somewhere back here, has an incubator next to Caltech, and builds out 40 businesses at a time out of that incubator when Thomas Pompidou begins to take this into Asia. It's where the individuals are going that you're going to get what looks like small business creation becomes very large. And you've got a real step change in who's running these businesses, because it used to be white-haired folks like us. And now if you think of the key CEOs, none of them's got white hair, right? You think of the Google kids, you think of Mark Zuckerberg, you think of Elon Musk. There's a very different generation starting small businesses that become businesses the size of nations. And that isn't captured in these graphs.
Yeah, very good point. Fred, a lot of people I don't think realize the emphasis at the Export-Import Bank focuses on job creation. Could you give us some examples of how you think there might be some opportunities in foreign sales of smaller businesses that typically have not tapped into that export market?
Sure. Actually, at the Export-Import Bank of the United States, we're an official trade bank of the United States. Just for background, there are about 85 of them globally. Our mission is really about U.S. jobs versus U.S. companies. We're probably one of the only export bank that's not a national interest export bank. And by that I mean, if a company operates in the United States and they're employing people here, or a service business, we will support their export. So GE makes things in South Carolina and New York State. We support them. They make them in France or Brazil. They should go talk to the Brazilians or the French. So here, or actually right here in California, I can think of two examples. Actually, a woman I'm going to be seeing later today, a woman named Nancy Mercolino, a company called Ceilings Plus. And when Doha is building a new airport in Qatar, and her company got the design and contracting to design and build the entire ceilings for the entire airport. So that's created a lot of jobs right here at home, both design jobs, manufacturing, and ultimate installation. And that's a small business. Another company called Firm Green down in Orange County came up with the technology to convert landfill methane gas to usable energy. I visited their site in the largest landfill in Latin America, in Rio de Janeiro. So that was a $50 million contract, and that created a lot of jobs in their entire supply chain, because they are a systems integrator. They manufacture part of it in Ohio and other states. So these are good jobs. The export jobs that we were just talking about, they pay up to 18% on average more than average jobs, because they're more market goods. They're goods that actually have to compete globally. We at the Export-Import Bank calculate our job supported every year. Last year was about 109,000. And since President Obama came into office and I became chair, it's been about 1.4 million jobs. So that's everything from a Boeing, which makes satellites right out by LAX airport, to a little company, as I mentioned, like Ceilings Plus, or actually there's a great little company out in Malibu that sells hair care products. You know, believe it or not, we export shampoo and things like that to Eastern Europe. So those all creating a lot of jobs. And at Exim, actually 90% of our customers are those small businesses.
Do you think members of Congress are hearing that message?
Some.
Not all, perhaps?
Not all. You know, one thing I learned is I had 5 hearings last spring, and hearings aren't always about listening.
Suggesting it's sometimes about politicians wanting to hear themselves speak?
Well, you know, some people have a theory of the case that is just a theory of the case. And I was in business for 20 years. I'm working with entrepreneurs and business people on exporting goods and services and seeing what the competitive landscape is like out there. We had a very protracted, frankly, ideological debate about the Export-Import Bank. We're a sunset agency, not those beautiful sunsets over the coast, but a sunset that closed or lapsed. We lapsed for 5 months and 4 days. Not that I was counting those days.
I'm sure you were.
But it was an ideological argument. It's ultimately an argument we've been having. If you've seen the play Hamilton, we've been having it since the birth of our country about what's the role of government? Should there be a role? Does it have a role to play? And what should that limited role be? And, you know, our view still, if I look globally, we have probably the most limited role of government in the world, but limited isn't zero. And that's part of this debate we're having, and that was part of the debate that we became wrapped up in.
Let's turn to financial markets, investment, and commodities as well. Blue, there was kind of a mini panic in financial markets earlier this year. What do you think were the primary sources, and what caused them to correct themselves so quickly?
I don't know if people in the industry would think it's a quick correction, but you know, we went in 2013 and 2014, and particularly the latter half of 2014, we had the fall in oil prices. We've had big falls in iron ore. We've had big falls in copper. Yeah, it's across the board in these base commodities and energy-related things. And I think we spent 2015. The first half of 2015 in the denial phase. If you were in that industry, it's going to come back. It's just temporary. It's China. You made up all kind of excuses. By the second half, you were out of denial and into I got to restructure my company. I got to restructure my debt. I got to sell some assets. I got to do what I got to take to be in this for the long run. And that's what companies did, and they did it very well. But when you're doing that, you're not selling, and you may sell oil or copper or something like that at a distressed price just to get your restructuring done. And so that typically causes prices to go below their longer run equilibrium. And I think as we've reached into 2016, we've had enough changes in the market that we're seeing we've left behind that period of last year where markets said, I'm ever afraid of lower prices. That fear is gone. Now we're just trying to figure out whether oil should be $40 or $45 or $35, and it's a whole different kind of attitude. It's much, much more positive for global growth. In fact, I think it's an indicator that we'll see stronger global growth. It's really good for emerging market currencies because a lot of them are commodity producers, and not all emerging markets. This counts for Australia and Canada. So this stabilization at lower levels, but finding trading ranges is a huge sea change in commodity markets. And I think it's very, very powerful and ultimately very, very good for the long run.
Monty, could I ask you to jump in and comment on what you're seeing in financial markets and how it might be affecting your business, the economy overall?
Sure. Assets are priced, including stocks, generally are priced on the expected future cash flows of those assets. So that would be net income or earnings, discounted back at the prevailing cost of capital or the cost of capital of the investor. And we can use the short rate as a proxy. So as expectations of future cash flows increase, stocks go up, they decrease, stocks go down. And as the cost of capital and expected cost of capital goes up, then stocks go down, and the reverse is true. Well, what happened is interest rates went up a quarter point, and the expectation was that they would continue to go up. And this is bad for assets and the pricing of assets. However, at the time, the thought about future corporate profits was more robust. And so that was seen as an offset, and therefore pricing for stocks was relatively stable. However, as we got into the first quarter, what we saw is that because of potential hard landing in China and some other concerns around the globe, that these future corporate profits may not be so robust and might actually be in decline. And that caused some great concern because now you had the expectation of ever-increasing interest rates, the cost of capital, and the cash flows of the companies themselves perhaps stabilizing or declining. It wasn't until there was a greater expectation that the interest rate increases by the Fed would be stretched out over a period of time, therefore cost of capital is lower, that helps stabilize the situation in the marketplaces. And according to that graph that I put up earlier, with so much debt in the economy, relatively small changes in interest rates can have a profound effect on our economy. So as long as the Fed stays dovish, then I think we're going to be okay. If they start to become hawkish or raise expectations of interest rates, then we can get into trouble. If you look back over the years, every recession we've ever had has been caused by the Fed, purposefully so, right? They raise interest rates because the economy is overheating, and they overshoot, and the economy goes into a recession. So this is the cycle. It's when the Fed raises interest rates too much that pushes us into recession. So I think that's what we've got to be cautious about about raising interest rates too quickly.
Let me jump in here for
Yeah,
a second. If
please.
you could put slide 56, I just want to pile on a little bit on that corporate profits idea. You know, this is the corporate profits as measured by GDP. So this is every company in the United States, public, private. This is not the S&P 500. This is not, you know, which is a little better than this. But the point is that we really have slowed down on corporate profits. They've gone negative in the GDP data. We don't have any inflation, or very little. So what that means is that to grow top-line revenue is difficult on average. And a lot of companies continue to grow their earnings predominantly by keeping their costs under control in this environment. So it's a really tough environment to grow earnings in this situation. And so we're in a market where the average, this is the average, is very misleading because there are going to be sectors that are recovering from last year, like energy and things like that. There are going to be other sectors that are maturing, like certain technology companies that aren't going to be as growthy as they used to be. So we're going to have a ton of action in the specific stocks and in the sectors that we're just not going to see in the market as a whole, I don't think, because of this fairly sluggish picture for corporate profits overall.
Thank you very much. Juan, I wanted to ask you if the equity market turmoil in the first quarter had much of a negative impact on kind of IPOs in the early stage market. Did you see any reverberations all the way down through?
Yeah, I mean, there was a massive pullback on IPOs for tech companies. And that's not necessarily an awful thing, because you tend to overshoot and you tend to take a lot of stuff to market that has no business being in market. And there's two very different sort of venture universes. There's the California universe where there's almost no gravity and you can price assets at whatever you want. And that's had some consequences. And then you've got, a more quiet Boston. Do you actually make money? Do you actually have cash flow projections? Will this be valuable? And there's advantages to each, right? California sometimes dreams enormous dreams, and they sometimes come real. But when those bubbles burst, they can be really expensive. Boston's in a different sort of mindset, and that may not be a bad thing as you move into life sciences and nanotech and a series of other things. I think you're going to see incredible engines of creation at both ends. But the prices are different, the logic is different, the way you do the deals are different, and the crashes are different.
Right. Let's go to slide 21. Let's give people a sense of just how much oil and gas exploration has been hurt by the decline in prices. This shows you the Baker Hughes active rig count has basically fallen from slightly above 1,600 to now down to about 400 in just a short period of time. Have we seen this bottom out yet?
Well, this is a fascinating chart, and I tell you, it mystified a lot of analysts because you cut the rig count in half and production holds up. What we've done in the shale sector is what we call finish wells faster. That is, it used to take 2 years. Now we get it all done in 1 year in terms of faster production out of that well. We've reduced the cost of setting up the rig at its next site. These rigs actually walk now. They're pretty slow, maybe 5-6 inches a day, but it's cheaper than taking them down and putting them up. Everything about the extraction industry has gotten cheaper and more flexible. And it didn't just like happen in 2010 when this chart takes off. It's happening every quarter, every year. We're making improvements. And so if you're in the rig business, this is not a great chart. But what it really is telling you is that we have incredible flexibility in the U.S. energy production market to take production up, to bring it back down. The U.S. is now, with the Middle East producing flat out because they need the money, the U.S. has become the swing producer in the energy sector, making our index the West Texas Intermediate oil, really the global benchmark again. North Sea's a declining asset. Let me go to one more chart just for 10 seconds. If you could go to chart 50. This is telling you that there's going to be further disruption in the energy industry. If I give you $1 and asked you to buy energy from any source. If you spend that dollar on natural gas in the United States, by the way, this only works in the United States. If you spend that dollar on natural gas, you're going to get 500,000 BTUs for $1. If you spend it on refined product out of crude oil, you're going to get 200,000 or a little less. Okay, that's a huge ratio, and these are the kind of things that get economists all excited because there's money to be made here. The only problem is it takes billions of dollars, a lot of government permits. It takes 3 or 4 years. It's slow. It's like watching paint dry. Let me just remind you, paint dries. We are going to export natural gas to the rest of the world. Ships are now leaving. This industry is by no means remotely stable if you have any belief in the power of pricing.
Monty, you said something on our call getting ready for the panel that I thought was very insightful. You pointed out how you use financial tools such as interest rate swaps can really mitigate the escalation of uncertainty that can freeze an investment in hiring. Could you give an example of how you would have used interest rate swaps in your business where people typically don't think that people in the leisure and hospitality use them?
Sure. My family's been in the hospitality business for decades, and I mentioned earlier about how I grew up in Houston. Well, my father in the business during the 70s, I like to think was a great hotelier, and as a result, he did very, very, very well with all the assets in the Houston area. In the 1980s, apparently he wasn't nearly as good as a hotelier because he got absolutely crushed. And what that taught me was that it didn't matter how good of a hotelier one is, or how good you are at operating your business, macro factors can make you or crush you. And that's what happened. And so during the course of my career in the 1990s, we bought more hotel assets from the RTC than anybody in the country. Goldman Sachs was number 2. And then towards the end of the 90s, we took our almost 200 asset portfolio down to about 30 as prices ran up in the late 90s. Then when the tragedy of 9/11 happened, we took a platform public, and asset value started to grow again. And we run a REIT now, a publicly traded REIT. And REITs are difficult to sell assets out of. There's some restrictions on how fast you can do that. Well, as the economy improved and as the assets were performing great, I was scratching my head, and I told to myself that I'd be darned if I'm going to let a recession come up and wipe away all the wealth that we've created. So we led an extensive project internally trying to figure out how do we hedge? How do we not get caught with a lot of these assets that have a lot of operating leverage on them already and get hurt in the potential downturn? And as you can imagine, we found a very high correlation between RevPAR, revenue per available room in our industry, revenues, as they compared to interest rates. And that makes sense, right? As RevPAR is growing, the Fed's raising interest rates. And as RevPAR starts to drop because of recession, the Fed cuts interest rates. Well, almost all of our debt was fixed. So we said, let's do this. Instead of having fixed rate debt, let's swap it all to floating. That way, as my operating income goes like this during recessions, my debt service payments also go like this and follow. Therefore, my bottom line is a lot more stable. We swapped $2 billion worth of fixed rate debt to floating rate debt, not because we knew exactly when a recession was coming. It just made sense in that if interest rates continued to go up and we got hurt on the debt, it's because the economy's booming and or we're having inflation, which is great for hotel assets. We could continue to raise rates and do very well. So I was willing to trade the potential upside of having all that inflationary growth and having a fixed debt service stream for protecting the potential downside. And sure enough, the recession came and it was a lot worse than we and most people expected. But what it did is it saved us hundreds and hundreds of millions of dollars in debt service payments. And that offset our operating losses. And I'm just surprised that more businesses don't hedge their business in the financial markets in this way or other ways, because it was a great situation for us. In fact, we took all those interest rate savings and turned around and bought back half of our stock in the public market, because our stock dropped from $14 to 89 cents. And we bought it back at an average of $3.27. So this is the right way we think is to run a business and to hedge those risks.
There's a lot of interesting hedging, too, back to the energy market. You know, when oil prices hit $27 back in January, everybody was looking at $27, except, of course, the oil producers. They were selling that oil in the futures market 1 to 2 years ahead for $40. They didn't sell it at 27. And that really messed up oil analysts really bad, because when inventories rose, which they did, they would think, wow, oil prices have to go down further. No, those inventories had been sold. They just got to sit. By the way, we call this the cash and carry trade. But this is how, you know, the energy groups have really started to embrace longer term hedging. And so the spot price of oil may not tell you what you thought. The inventories are being held. Some of them have already been sold forward. So it's the risk management aspect of this is really huge on how it smooths out and makes our economy more robust.
We've done work at the Milken Institute that shows that companies that use these hedging products, the market places them in a higher multiple price to earnings because they know their earnings are not as volatile. And you can see it in all the data. Judith, let me turn to you. I know Walmart has had a major initiative to encourage greater investment in the United States, trying to bring some manufacturing back here. Lower natural gas prices in the US certainly make that equation look a little bit more favorable. Maybe you could share with the audience the effort that Walmart has underway.
Yeah, so if you think about some of the conversations we've just been having, and macroeconomic factors and all of the other things that go into where we are from an economy at the moment, I think businesses can also play their part in helping strengthen where we are. Our initiatives on Made in America is just an example of that. So a pledge over a 5-year period to put $250 billion into US products that support American jobs has been a really key initiative for us. As we've looked at that and worked some of that through, there are 3 key areas that we've been operating on. There's reshoring, which is products that were previously made abroad, and it's kind of the opposite of what you guys are trying to do. Previously made abroad that we're bringing back onshore into the US, be that candles that are made in Poland, be that bikes being assembled in China. So bringing products back on. From an existing manufacturing base, how can we strengthen that manufacturing base? How can we put more of our production through that and make them more efficient in the production that they're doing so they can cope with the demand that's coming from a business from the scale of Walmart? And then the third area, which plays into the whole innovation point, which is going out and saying to US businesses, where can you innovate and help create products that are relevant to consumers for now? And we run these open calls, and we literally open house in Bentonville and say, come and show us what you've got, come and show us that it's manufactured in the US, the components are from the US, and how can we best use that in terms of helping to drive the business forwards. It's a great idea, not only from a business perspective, but 85% of customers say that they want businesses to be doing this kind of work. The interesting thing is you can't do it for everything. And you have to be selective in the areas that you look at. And we've got about 500 initiatives at the moment that are bringing items back to the US. If you think about cool boxes, it's a lot of air. Transporting air is not good economic sense. So actually manufacture it closer to source. Seasonal products like patio furniture, it's easier to respond in a season if it's manufactured closer to the point that the consumer's going to purchase it. And we've had some great examples. So Kent International, which is a bike company, they have brought back to the US a lot of their US bike manufacturing assembly. And over the next 5 years, they're going to keep on investing and create another 200 jobs. So, you know, the role that businesses can play in helping support a healthy US economy that underpins all of these macro factors is really key.
Thank you very much, Judith. This is a question for anyone on the panel. How much of an effect do you think the rhetoric from the presidential primary campaigns is having on businesses' willingness to commit capital investment? Is it having a material effect, or is it just, you know, a bunch of blowhards talking politics?
I personally don't think it's having a large effect yet. We're not hearing that from customers. Most of the impact we're seeing is from the past few months, which is concern about profit growth. And Blue indicated earlier, how are they going to keep profits growing? Well, cutting back on travel is, again, usually the first thing that they do to shore up their income statement. So we're not seeing that and hearing that from our customers, at least.
Yeah, but I think a lot of the people that analyze the politics do realize that if you don't control both houses of Congress, you're not going to get anything done. And the Senate, there are a lot of seats open in the Senate, and many of them are in purple states, so they're going to be hard fought. But it's very hard to predict that any party will get the 60 votes to really control. And so as much as you might get emotional over the presidential debate, the likelihood of Washington actually moving away from gridlock seems fairly minuscule.
So that's the good news then, that they don't move away from
absolutely.
gridlock.
I mean, economists, we always raise our forecast when Washington's doing nothing. It's worked very well the last 7 years.
I couldn't agree more. Last time our government got something done, they passed Obamacare and Dodd-Frank. And I don't think those are two pieces of legislations that are heralded as great help to the economy.
Yeah,
I push back on that.
Somehow I thought Fred was going to do that. Shocking.
You know, listen, we had to fix our health care. Nothing is perfect. Nothing is born perfectly. But when you have one party that has had 56 or 57 attempts to repeal it versus reform it or change it, it's very hard to have a negotiation. So we've got a lot more people covered by health care. We have reduced the estimates on healthcare costs, and this is not my area of expertise, have actually dropped over the next 5 years, and those are improvements. Dodd-Frank, again, you know, regulations aren't perfect. We've been a number of the financial institutions spent more money fighting them than trying to find make a way to work with them. So it's very easy to just throw things at that, but you create laws, and laws are passed by Congress. They're not devised by bureaucrats working in federal agencies. They're actually passed by Congress. People running agencies such as ours, our job is to implement them.
But
Are you telling me,
that's
Fred?
just not true. The amount of regulatory power that's given to these agencies to come up with the rules is immense. And in fact, in Dodd-Frank, it's taken years and years and years for the agencies actually to develop the rulemaking around these laws.
But
they're onerous, and they inhibit lending, and they inhibit business. We consummated a transaction of the negotiation in August. We're still not closed because of all the regulatory approvals that we need from our government in order to get a little Mickey Mouse $300 million transaction done. It's too much. The regulation is too much, and it's harming growth in our economy, and it's harming job creation, and it's got to stop. It's like a one-way ratchet. When the conservatives are in, they ratchet up regulations
laws
a little
are passed
bit,
by Congress.
and the Democrats are a lot more than a little bit.
Executive branch
much.
doesn't pass laws. The Congress passes laws, and the executive branch is empowered to execute them. And if the regulation isn't appropriate, there's a comment period. It's a very public period. I'll give you one small example. We, at the Export-Import Bank, were, before I got there, under President Bush, we were sued because we were not following the environmental regulations, the laws that Congress had passed. So the agency was sued. We had to put in a different regulatory structure to comply with the judge's decision on the lawsuit. That's frequently what happened. A lot of these regulations were happening because agencies in the previous administration were not following the law, were sued in class action suits and so forth, and as a result, had to put in a number of regulations to comply with laws that Congress passed.
Blue, why don't you jump in here?
Yeah, let me take a different tack on this thing. One of the things that increased financial regulation has done, including Dodd-Frank, but regulations before that, is it's like a pendulum in which the more we use capital ratios for banks and VOCA rules and things like that, if we apply that, we actually take away power from the Federal Reserve to control the economy. So there's a trade-off between regulation that's designed to minimize systematic risk, whether it works or not, against the powers of monetary policy. So if you look at chart 4, slide 4, you see this, we've done $3.5 trillion of quantitative easing. We've had zero rates. We have a 2% economy and very little inflation to show for this 7 years. So these policies have absolutely failed in any attempt to make a difference in encourage the economy. And I would argue that it's not just Dodd-Frank. It's 20 years of increased financial regulation going back to the S&L crisis, really, that has taken away power from the central bank under the name of getting rid of systematic risk. Now, I don't know if that's good or bad. I'm just observing that's happened. But what I can tell you is that I don't think we've really gotten rid of systematic risk. I have the balloon theory. And the balloon theory is you have a certain amount of risk in the economy and you squeeze it out of here and it shows up here. So, you know, maybe it's not in the banking sector now, but it's in the economy. So I'm not even sure that we've done the systematic risk part, but we have changed the calculus of what central banks can and can't do on macroeconomics, and they just can't do as much as they used to.
You bring a good point, Blue. If you look at the debt to GDP ratio, it peaked in 1929 and then on to 1933 as the debt compared to the size of the economy was just too big. That created a liquidity crisis and that put us into the Great Depression. A lot of debts were defaulted on. That ratio was right-sided, and because of a number of other factors, it was right-sized for a number of years and then started to get out of control and again peaked in 2007, where this debt to GDP ratio was just too high. There was not enough liquidity in the economy. And so we had the Great Recession. These are cycles that happen naturally in economies with debt building up too much, then you having to have some type of event that reconciles it all. Yes, there are some contributing factors, but to try to stop this natural phenomenon, it's like trying to stop the business cycle. It just happens. And so it seems like it's a solution. Dodd-Frank was jumping out there to try to stop something that it's not going to stop. Debt is going to build up again. And if we don't have enough liquidity in the economy, we're going to have another crisis. Now, we have enough liquidity right now, so we're okay. But Dodd-Frank, my understanding, was supposed to stop too big to fail. That has not occurred. And it was supposed to prevent banks from investing in risky assets. That has not occurred. So it's too much regulation. It's too much, and it's hurting the growth of our economy, especially in those fields such as ours, which are low growth. Demand for hotel rooms grows at 2% a year. If you're an internet firm and your revenues grow at 40% a year, none of this matters. But for the middle part of the country and for the lower growth business, the regulatory environment is just too much, and it's really harming business, in my opinion.
And just say on this, one of the things we just have to be really cautious of is you think about this conversation is actually how this is playing out to the consumer and what they are seeing and what they are hearing and the level of uncertainty that that is creating for them is actually one of the risks that we have. And it's probably unprecedented at the moment with the way this is being played out in public forums and being heard. And I think that is really starting to have an impact on how people feel. And this base of consumer spending, which we absolutely need to keep moving if the economy is going to stay healthy and strong.
Are there any...
You know, I will just add one thing about regulations. Nobody likes regulations. It's like nobody likes the referee. A regulation is essentially...
Kind of like moderating a panel.
It's like moderating a panel. Yeah. The referee, their job is to...
There's too many referees.
Well, there may be too many referees, but you know, but one thing I do hear from business over and over again is about taxes, which actually we do have to reform, and regulations. You know what? But there are other things that are holding our economy back, and just to focus on those two to the exclusion of everything else is a giant mistake, and it takes us in the wrong direction.
Well, with that, let me ask if anyone is concerned about over-leverage in the financial markets anywhere. Do you think there's the problem brewing that we haven't yet identified? We usually identify them after they happen, but are there any concerns about over-leverage anywhere in the financial system that you're concerned about?
Not here. But in China,
well, give us the insight.
I'm very concerned about it. You know, you have a shadow banking system, you have not a well-formed banking system, and you have a lot of debt piling up. So, you know, I don't think we're out of the woods on debt piling up around the world, but I don't see the U.S. as being the epicenter of another problem. One interesting thing, though, that I'm struggling with as an analyst looking at this chart and thinking about it is central banks have bought a tremendous amount of government debt. I mean, we often quote the statistic that Japan has government debt equal to 200% of GDP. But today, 100% of that is sitting, or half of it is sitting in the Bank of Japan. Yeah. Now, when I worked as an equity analyst, I always looked at the consolidated balance sheet. So I would, even though the Fed is technically private, it's not. So I would merge the balance sheet of the central bank with the Minister of Finance or the Treasury Department. And if I do that, I find that some of the offending governments are not nearly as in debt as they used to be. And I haven't seen any of the credit agencies do any analysis on this. It does mean that if interest rates were to rise, central banks would lose a ton of money. That's a big if they were to rise. Also, but if anybody can lose money and stay around and print more of it, that would be central banks. So, you know, I'm not going to worry about that. And besides, if my left arm owns my right arm money, I mean, what, you know, I don't think that really matters.
Lou's
So I
exactly
think-
right. Most people don't realize that all the interest payments that go from the that are owed from the Treasury that have to pay to the Fed because they hold so much debt, after the Fed pays their expenses, they take all that money and send it back to the Treasury.
Yeah, it's $90 billion a year that they're sending back to the Treasury. Now, if interest rates were to go up, that means their funding costs would go up. And, you know, the Fed's an interesting kind of financial institution. They're leveraged 62 to 1, which might scare you. They also don't hedge their interest rate risk. That might scare you. But, you know, if you consolidate them, it's not so bad.
Juan?
So, you know, I'm interested in long-term systemic issues. So I'm interested in technology, and I'm also interested in why countries appear and disappear. And I put out a book in 2005 that basically said, look, you're going to have a really big financial crisis. It's going to be driven by real estate and over-leverage. And there are real consequences to massive financial crises because they can drive regions and nations apart. And you're seeing that in a whole series of places where the rich are basically separating themselves from nations because they don't want to pay for southern Italy, because they don't want to pay for southern Belgium, because they don't want to pay for southern Netherlands, because they're Scots, because they're Welsh, because they're Basques, because they're Catalans. But it's not the poor that are leaving, right? It's the rich that are creating these incredible islands that eventually create nations, and that's why 3/4 of the flags, borders, and anthems of the UN did not exist 75 years ago. It's a systemic thing that's going on in the world, and I think we're sitting in a really dangerous spot. And I think we're sitting in a really dangerous spot because the leverage of corporations has come down, but the leverage of governments, if you look at what Japan has done, if you look at what China's done, if you look at what the US has done, these balance sheets are really dangerous balance sheets. And when you've got interest rates down about zero, the leverage that you have, if you have a shock on the upside that takes interest rates up, really looks ugly. And you don't have, on the downside, the ability to really adjust this stuff. And I think we're sitting in a place that is really delicate and that can have some real systemic effects because we don't know where the risk is. We're watching the banks, and that's not where this thing's going to blow up. That debt has gone in other places. We listened to a couple of panels yesterday where people were telling you we're taking the products that the banks can't issue. But there may or may not be the oversight over that stuff. And if anybody's interested in pursuing this stuff, give me a business card and I'll send you this book from '05 because I think it's still reasonable and applicable, and I think we've got a real systemic global issue on this.
Thank you,
I
Juan.
think he brings up a great point, and I'll be brief, Ross, in that I think the only way out of this is in order to get the money from the wealthy, from the savers, to the spenders, to the borrowers, is ultimately to take interest rates materially into negative territory. And there's all types of things you have to do to protect about that and hoarding cash and on, but those are mechanisms that can be addressed. But there's nowhere is it written that if someone lends to someone else, one party pays to the other. It can be the reverse. And there's so much savings, so much debt, that if you take rates materially into negative territory, what that does is it tells the rich, it tells the Germanys, it tells the rich in every country, either you spend that money and help the economy, or it gets taken away from you at a rate of 5-10% per year. And either way, the problem's solved. The economy booms and labor gets a greater share of income, or the money is taken away from the wealthy and the total debt balance is reduced.
Thank you, Monty. I want to spend a little bit of time on trade before we wrap up. As we said, there's been a lot of bashing free trade agreements in the past few months. But international trade, especially in goods, has slowed down. It used to grow twice as fast as GDP, and now it's growing at approximately the same rate. But what a lot of people haven't noticed is that service sector exports are still growing faster than GDP, with information communications technologies allowing us to deliver services across borders. Is that an area where the U.S. can expand in terms of we have a competitive advantage, exports of services?
We actually run a trade surplus generally in services. We run a trade surplus in commodities, as I mentioned earlier. So, yes, I think that is definitely an area we can excel in terms of, and it's everything from engineering services, legal, insurance, design, that full area, as well as tourism and so forth. So, I think it's certainly an area we can excel in. I think that, we actually, because this free trade has a bad connotation, first of all, people think we're giving something away, which is a bad word.
Open trade?
Well, it's why they call it the Trans-Pacific Partnership or the Transatlantic Trade and Investment Partnership. You don't hear the word free trade anywhere in those agreements because that just has a bad connotation today. I actually partly I put a lot of the responsibility on companies and how they talk to their employees. I go to the Boeing company is a great example, frankly. You walk into a Boeing factory, and the tail fins are painted with all the destinations where those planes are destined. Every employee knows that 70% of those airplanes is destined for overseas. Right. Those employees understand that trade actually is what pays their salary. But we have, sorry to say, too many companies, in my opinion, that they lobby on taxes and regulation, and when they're done with that, they lobby a little bit more on taxes and regulations. Then they do taxes and regulation, and then everything else occupies 5%. Trade, IPR, infrastructure, STEM, you name it. And I think businesses can change the dynamic on trade. I just think more companies have to do it, and they have to recruit the employees to do so, because the employees are the beneficiaries. And I think that's gotten lost in this debate, and I think business needs to really pick up the slack on that.
Could I have slide 29, please? This is a moderator's prerogative. I was having breakfast about a month and a half ago with a former finance minister of Mexico, and we were discussing the presidential debate, if you want to call it a debate, yelling and shouting, and trade agreements. And so he challenged me to come up with a way to kind of easily demonstrate that trade with Mexico, and if Mexico does well, it's not a zero-sum game. So I took an attempt at this. I used to work for a macroeconometric model builder by the name of Larry Klein, won a Nobel Prize. So I just like to play around with these things. So this is using international model, trade-weighted, and it shows you what happens if Mexico increases their exports by 10% versus what happens if China increases their exports by 10%. The point here is that the US and Mexico and Canada are integrated in a North American system. And when Mexico's exports go up by 10%, US GDP goes up by about 0.1%. That's a lot. And you look at industrial production, it goes up by 0.31. Now, another way to look at it is if you get a 10%, that's the next slide, slide 30. If you get a 10% increase in income in either Mexico or China, the US gets a much larger boost from Mexico, a little bit better on the China side. But Juan, if I could, since you were head of urban development for Mexico City, what do you think about this debate on the trade relationship with the US?
So, again, coming back to countries appearing and disappearing, we're in a very strange spot because for the first time in human history, if you really screw it up, your neighbor won't take you over, right? It used to be if you really screwed up your country, somebody would come in and just kind of grab you, and they'd grab your assets, and they'd grab your oil and everything else. And in a knowledge economy where we're producing about 90% plus of wealth coming out of knowledge, there is absolutely no reason why the US would want to take over Iraq, right? Not even if it's gift wrapped, not even if they ask nicely. So the first question the military asks is, how do I get out? Which is a completely different logic from what used to operate on a nation-state system. And the problem with that is that when a state fails, because of drugs, because of this, because of that, then Europe gets overrun by all these folks because nobody's going in and restructuring the nation. The nation's failing, it's falling apart. You're watching that happen in Venezuela right now, like fast, real time. I hope it doesn't happen in Brazil. You may watch it happen in parts of Mexico with some of the drug stuff. And the consequence of that is we have to think very carefully about this nation system and this trading system, because it's not just a zero-sum game, and you don't just build a wall and you're isolated. And I'll give you one very specific example that we're thinking of right now really hard. Traditionally, inheritance skips generations, which is the reason why not everybody gets sick, right? Some of your cousins do, you don't. We now have a technology called a gene drive that allows you to make every single mosquito inherit the same trait. Why is that important? Because we can kill Zika in Brazil. But that doesn't stop at the border, right? Those mosquitoes are going to go and kill Zika everywhere. In fact, it may kill that species of mosquito everywhere. And we're going to see more and more of these systemic issues, and these trade debates aren't just abstract debates over this or that. These are abstract debates about how our quality of life works, how we're going to live, how secure we're going to be. And they're really important debates.
If we could, we have just a few seconds left. I'm going to start with Monty. Give us something that makes you optimistic about the long term in the U.S. economy. Bullet point.
Innovation, the entrepreneurial spirit is fantastic here in the United States. And despite some of the headwinds that we've talked about on this panel, that doesn't seem to be changing anytime soon.
Juan?
There's never been a better time to be alive. There's never been a chance to take more countries out of poverty, to build more jobs. We can't hire fast enough. Our kids are going to discover life on other planets. They're going to travel to other planets. We're going to generate. This is just the coolest time despite these problems.
Fred?
I think innovation, the entrepreneurs in America, and frankly, the global middle class that's growing, there's going to be a lot of opportunities for us.
Judith?
I would agree with innovation, but also this economic mobility for people, the ability for the US to create upward mobility for its workforce over the next few years, I think is very key.
Monty, you get the last word. Monty, I'm sorry, I'm not going to give you the last word. Blue.
I'm optimistic because I think we're moving out of an era where we depend on central banks and government, and economies are incredibly robust, and we underestimate that, and we're going to be very pleasantly surprised at how well things do, given how afraid we are.
Thank you very much. Please join me in welcoming our panel for a very lively debate discussion. Thank you.